Good day to you guys. So in this video I want to talk about liquidity. So basically guys, liquidity is pool of money, or else you guys can call it a pool of stop losses. So most of you guys have heard this term liquidity, and the market use this as fuel, and the market moves according to the liquidity. So imagine like we have more sellers in the market, so then the market will eventually shift its order flow into sell side or its bearish side and sweeps buy side liquidity and then goes back to sell side structure. So in here you guys can see we have support zone and we have a resistance zone. So the basic term support, I understand most of you guys have heard about this term, right? So the market will move inside these two ranges, and then just imagine something like this: the market has to go down, that means the order flow is bearish, the bias is bearish, and then what this will do is it will sweep the buy side liquidity over here and then it will go to sell side liquidity. So something like this, okay, let's sweep in this liquidity and then going to sell liquidity. So over here we have stop losses of buyers and sorry sellers, and we have the stop losses of buyers. So that's how it goes, guys. So here we call this buy side liquidity, BSL, and for this we call it sell side liquidity, SSL. And I told you guys the market has two types of liquidity. So one is buy side liquidity and one is sell side liquidity. So liquidity can go far more deep than this, guys, because liquidity term itself is an institutional term, and you guys have heard about liquidity runs, right? So simple as this, you guys can use this liquidity run theory in any time frame to anticipate the next market move, because guys we have ICT concepts. So in ICT concepts, liquidity run is belonging to the core content. I'm not saying that you guys will get 100% accuracy by using these theories, but the thing is it will be much more easy and you guys can win in a consistent manner. So in here we have liquidity runs. So we have two types of liquidity runs. We have internal range liquidity and then we have external range liquidity. So basically guys, um, it's something like this. So in this case it's a bullish market, so the order flow is bullish, and over here we have these highs over here. Okay guys, so imagine that we are in the 4-hour time frame and we have fair value gaps over here. So if you guys doesn't know about fair value gaps are something like this. So we have three candles, and imagine that the price isn't balanced, or is there's some sort of a gap over here there. So that means we have a gap here. So the market has to come back down like this and then goes back up. Okay, so we call this area as fair value gap. So we have 2 weeks over here and the 2 weeks doesn't align, so that means we have a small gap over here. You guys can see that, right? So simple as that, guys, we call it fair value gap. So after that you guys can see that the price has come back down to this fair value gap and then goes back to this external range liquidity. So we call this external range liquidity, ERL. You guys can identify this external range liquidity by using the swing points. So how do you identify a swing points? It's something like this. So there's a candle over here, its wick has taken all of the liquidity over here and new liquidity will be resting above that wick. So that's the logic behind a swing point. And yeah, so the same scenario applies to bearish order flow as well. So see you in the charts, guys. Okay guys, so here I'm in the forward chart GBP USD. So I forgot to tell you guys, you guys can consider order blocks as internal range liquidity. So keep that in your mind. Not only fair value gaps, you guys can consider order blocks as well. So in this case the market is going in uptrend. So I mean this leg. So if you guys consider the first theory that I told you, buy side liquidity and sell side liquidity. So in this case we have visible equal lows over here, some sort of rejection. And guys, some people just mark this zone as a resistance zone. That means we might have some liquidity resting below here. So the liquidity has been successfully swept over here, and then what will the price do if we go to sweep the buy side liquidity over here? So BSL, and we call this Sellside liquidity. So guys, we can identify this as accumulation, manipulation, and then the distribution. And some people can tell that this Buyside liquidity is acting as a external range liquidity, and he's 100% correct. And after that, the price moves back into this order block over here. So that means we can consider this as internal range liquidity. So we call it IRL. And I have to tell you that if the price is rejecting from a consequent encroachment level in a PDRA, that means in this order block, the 50% level is this one. So if the price is rejecting from the 50% level, that means the rejection is somewhat powerful. Okay, so keep that in your mind. And after that, the price takes this high over here. It is the external range liquidity, and then the price might go somewhere here, over here, you guys can see, and here we have the consequent encroachment level respected. So how do you guys find that if the consequent level is respected or not? A body cannot be closed crossing that level. That is the key, guys. A wick can be closed, but a body cannot be closed from that level. So after that thing, the price should straight up go back to this one. So in this case, we can take this as a practical level. So how do you guys identify the correct level? The internal range liquidity might be this fair value gap, or is this order block, or is this one, can be somewhere like that. So you guys can identify the correct range. So that means the correct range for this case is this high to this low. So you guys can use your OTE levels, something like this. So then in this case, you guys can look for confirmations in this order block, because most of the time this order block 50% level and this range 50% level might be aligned. So that means this order block has a good probability to become the internal range liquidity, and then you guys can just target these highs. And that's all, guys. It's that simple. So the same scenario applies for bearish order flow as well. So I just want to tell you guys, just use this use this OTE level confirmations and also this consequent encroachment theory when you guys are selecting your PDRAs. So the best thing that you guys can do is trade from internal to external, not from external to internal. Unless you are trading CRT model, you guys can use external to internal. But if you guys are trading something like classic sell days and classic buy days, one shot one kill, silver bullet, anything, it is better if you guys are sticking to internal to external range liquidity. Because guys, most of the time you guys can stay consistent if you guys are trading internal to external. So keep that in your mind. So it is a pro tip, like a plus tip for you guys. And in this case, we can consider this as our external range liquidity, and after taking that external range liquidity, market comes back into this order block over here. So once again, I can use this low to this high to identify where my next block will be. So in this case, the OTE level, the golden zone, has been respected for this block over here. So I can consider the consequent encroachment as well. So if I see rejections from the consequent encroachment, straight up I will take trades. So that's all, guys. I will take a trade targeting these lows, and I mean keeping my stop loss below these lows somewhere here, and targeting the external range liquidity. So that's all, guys. So I can take trades something like that. And yeah, if you guys are using time and price confirmations, it is much more easier to take trades. And guys, if you guys know about the order flow thing, you guys know that if the price is invalidating these lows, that means after taking this high, okay, so the low which helped to take this high is this low, right? This low. So that means the range is from this low to this high. Okay, so from this low to this high. So I'll explain you guys that thing again. So if you guys notice that the low that helped to take this high is this one, this low over here, this swing low over here, which made this high. Okay, and the range is this one. This is the correct range. Okay, so if the price is breaking this range, this low over here, that means there's a high chance of shifting the order flow. So that is how you identify if the market order flow is shifting or not. So in this case, it is that simple. So you guys can take trades from this block over here, or is this fair value gap. So it is that simple, guys. So if you guys have any questions, just let me know in the comment sections, and I'll see you guys in the next video. So peace.